Let's start with the scams that just emptied savings accounts and slowly work our way towards the ones that helped crash entire economies. Most people are afraid of thieves with masks and weapons, but some of the biggest robberies in history happened in air-conditioned offices with spreadsheets instead of guns, and thieves who wore designer suits and got invited to speak at conferences. In this video, we're counting down 8 of the largest financial scams that stole billions. They didn't need to break into vaults. They just needed you to believe a story long enough to sign on the dotted line. And by the time we reach number 1, you'll see how a few fake numbers on a screen can steal more money than entire armies ever could. Number 8. The Nigerian prince and global email scams. Billions, one small transfer at a time. We're starting with a legend. Not one scammer, but a whole genre of crime that's been haunting inboxes for decades. You've probably seen it. Dear sir, madam, I am a royal prince, a high official, dying millionaire with $20 million trapped in a foreign account. It sounds ridiculous. The grammar is bad. The story is insane. They need you, a complete stranger, to kindly send a small processing fee or temporary deposit so they can unlock their fortune and share it with you. Sure, you laugh, you delete, end of story. Except, not for everyone. Some people read that email on just the right day, when bills are piling up, when their business is failing, when the dream of one big break feels desperately attractive. They start emailing back. The scammer replies politely, formally, even affectionately. They send you fake documents stamped and signed. They call you partner, they tell you the transfer is almost ready. They just need one more fee. A security fee, a lawyer fee, a tax fee. By the time the victim realizes there is no prince, no inheritance, no miracle, they've wired away thousands, sometimes their entire savings. Individually, each victim loses a few thousand, maybe tens of thousands. But globally, across decades, across different countries and variations of the same trick, these email and online scams have stolen billions. And here's the really twisted part. The scammers intentionally write those emails badly. The spelling mistakes, the absurd story, that's not laziness. It's a filter. They want to weed out people who are too skeptical. Anyone who still replies after that first email is, in their eyes, the perfect customer, trusting, hopeful, and unlikely to stop halfway. Individually, they stole groceries, rent money, and retirement funds. Collectively, they stole skyscrapers. Number 7. Charles Ponzi, the original blueprint. Before Ponzi scheme became a term in every crime documentary, there was an actual man named Charles Ponzi. In the early 1920 seconds, Ponzi had a brilliant story. He claimed he'd found a clever way to profit from international reply coupons, little postal vouchers used to pay for return postage in different countries. Thanks to currency differences, he said, he could buy them cheap overseas and cash them in for more in the United States. Free money, basically. He offered investors returns of 50% in 45 days, or 100% in 90 days. People went wild. Imagine Boston streets filled with people lining up outside his office, all clutching envelopes of cash. Barbers, teachers, shop owners, immigrants who barely spoke English, everyone wanted a piece. Newspapers wrote about him as a financial genius. He paid early investors exactly what he promised. But here's the detail he left out. He wasn't actually making that money from postal coupons. Buying and trading enough of them at scale would have been a logistical nightmare. Instead, Ponzi simply took money from new investors and used it to pay the old ones. Classic rob Peter to pay Paul. As long as more money flowed in than out, the illusion held. People saw their friends getting paid, assumed everything was legitimate, and shoved even more cash across his desk. Eventually, the math failed. Investigators started asking questions. Journalists discovered that the amount of coupons needed to justify Ponzi's profits would have been basically all the coupons in the world, several times over. The scheme collapsed. Ponzi went to prison. Thousands of investors were left with nothing. He walked away with only a few million small change compared to what would come later. But he left behind something much more valuable to future criminals. A blueprint. Ponzi got a few million. His spiritual children would upgrade that to billions. Number 6. Enron, when an entire company was an illusion. In the late 1990s and early 2000s, Enron was a superstar. It was praised as one of the most innovative companies in America, a giant in the energy sector that had reinvented the business with clever trading and creative financial engineering. Magazines called it America's most innovative company multiple years in a row. Its executives were treated like rock stars. Its stock price soared. On the outside, Enron looked unstoppable. Inside, it looked more like this: a maze of shell companies, off-balance sheet entities, and accounting tricks designed not to create value, but to hide reality. Enron used a method called mark-to-market accounting in the most generous way possible. Sign a massive long-term contract, immediately book all the predicted profit today, even though no one knows if the contract will actually be profitable long-term. Make a bad bet or lose money, move the loss into a separate entity that doesn't show up on Enron's main financial statements. On paper, earnings kept going up. In reality, the company was eating itself alive with bad investments and hidden debt. Picture traders screaming into phones on the Enron trading floor, high-fiving over million-dollar deals. Then picture a few floors away, accountants frantically shuffling debts into newly created entities with long, forgettable names, trying to keep the illusion alive for one more quarter. Eventually, the truth leaked out. Analysts started asking why a supposedly thriving company needed so many weird off-balance sheet partnerships. Short sellers and journalists dug deeper. Confidence cracked. The stock price plunged. Once investors panicked and banks demanded real numbers instead of creative fairy tales, Enron collapsed almost overnight. Thousands of employees lost their jobs. Many saw their retirement savings wiped out because their 401 were loaded with Enron stock. Investors worldwide watched tens of billions of dollars vanish, all from a company that on paper looked like a miracle. Enron didn't just cook the books. They opened a 5-star restaurant and threw the oven at Wall Street. Number 5. WorldCom. When just change the numbers becomes a business strategy. If Enron was a masterclass in hiding bad bets, WorldCom was a masterclass in good old-fashioned lying. WorldCom, once one of the largest telecommunications companies in the world, grew rapidly in the 1990 seconds by buying up smaller companies and riding the internet boom. But growth eventually slows. Competition increases. Profits get squeezed. Instead of admitting this to investors, WorldCom's leadership chose a different route. What if we just pretend we're still making huge profits? So they did. WorldCom began reclassifying expenses as investments. Normally, if you spend money to run your business like network maintenance or regular costs, you record it as an expense. That reduces your profit. WorldCom simply shoved billions of those costs into the capital investment category on the balance sheet. On paper, this magically turned ordinary bills into long-term assets and made profits look much bigger than they really were. To the outside world, revenue looked strong, profits looked healthy, and the company appeared to be a stable giant in the telecom revolution. Inside, it was increasingly hollow. Eventually, internal whistleblowers and auditors uncovered the fraud. In 2002, WorldCom admitted to one of the largest accounting scandals in history, over $11 billion in inflated assets. The company collapsed into bankruptcy. Investors lost billions. Thousands of employees lost jobs and retirement savings. They were supposed to connect the world with cables and switches. Instead, they connected nothing and billed billions for it. They couldn't make enough real profit, so they just phoned in the numbers. Number 4. Boiler rooms, fake Forex and binary options. The global phone scam machine. Not all billion-dollar scams come with public stock tickers and glossy annual reports. Some operate from noisy rooms full of cheap headsets, fake accents, and aggressive scripts. Around the world, especially in the last 2 decades, countless investment firms sprang up promising easy profits in foreign exchange, Forex, binary options, high-leverage CFD trading, or later, shady crypto platforms. Their sales pitch was almost always the same. We have a proprietary system. We're regulated. Our clients are making 20% a month. This is a once-in-a-lifetime opportunity. In reality, the trading platform was often just a simulation. The prices were manipulated, and the only real positions being taken were on your wallet. Here's how it played out for many victims. A regular person gets a call or sees an ad. Start with just $250. See how fast it grows. They deposit. The platform shows impressive returns. Their $250 becomes $350, then $500, then $800. They try a small withdrawal. It works. Confidence unlocked. The broker, actually just a salesperson in a boiler room, pushes harder. You're clearly a natural investor. If you deposit $10,000, we can move you to our VIP strategy. At some point, when the victim has invested a serious chunk of their savings, the tone changes. Suddenly, trades start going bad. The account balance drops, or the platform experiences technical problems. When the client tries to withdraw everything, customer service stops replying. The website may disappear. The company name suddenly belongs to an empty shell in another country. Multiply this by thousands of victims across dozens of countries, and you're looking at billions siphoned away. The only thing they were really trading was your certainty for their commission. Number 3. OneCoin, the cryptocurrency that never really existed. In the age of Bitcoin, it was only a matter of time before someone realized, if people don't fully understand this technology, we can sell them one that doesn't even exist. Enter OneCoin. Founded in the mid-2010 seconds and marketed as the Bitcoin killer, OneCoin promised its followers a chance to get rich from a revolutionary new cryptocurrency. Conferences were held in huge arenas. There were flashing lights, loud music, and hyped-up presenters on stage declaring, "We are changing the financial system forever." People bought educational packages that conveniently came with OneCoin tokens. They were told the value would skyrocket once OneCoin was listed on major exchanges. There was just one problem. There was no real public blockchain, no decentralized network, no transparent ledger anyone could check. The coin only existed inside OneCoin's own centralized database, controlled entirely by the people running the scheme. They could set the price to whatever they wanted, whenever they wanted. To early investors, the numbers on the screen looked fantastic. Their accounts showed token balances climbing in value. Some were allowed to withdraw small amounts to prove it worked. So they told friends. They told family. They mortgaged homes and emptied savings to buy more packages. In reality, OneCoin operated like a massive, international Ponzi scheme. The value was an illusion. The real money came from new recruits paying in fresh cash. As legal investigations began and pressure increased, withdrawals were frozen. Events were canceled. Leaders vanished. Estimates of how much money was stolen range into the billions of dollars. Many victims were ordinary people in developing countries who thought they were finally getting access to a once-in-a-lifetime opportunity. The blockchain was imaginary. Unfortunately, the losses were very, very real. Number 2. Bernie Madoff, the $60 plus billion illusion. Most scams try to lure strangers. Bernie Madoff did something bolder. He scammed his friends. Madoff was a highly respected figure on Wall Street. He'd been the chairman of NASDAQ. He cultivated an image of quiet, consistent success. His investment fund wasn't widely advertised. In fact, getting in often required knowing someone or being recommended. And that was the point. Exclusivity became part of the brand. If you managed to get your money into Madoff's fund, you felt lucky, special, smart. Month after month, year after year, investors received statements showing modest but impressively consistent gains, never huge spikes, never huge crashes, just a smooth, steady lineup. Even when the broader market was turbulent, to many, that looked like genius. In reality, it was a fantasy. Madoff wasn't generating those returns through some brilliant strategy. He was taking in money from new investors, paying older investors who wanted to withdraw, and fabricating trading records to make it all look legitimate. He and his staff literally printed fake account statements and trade confirmations on old machines to simulate years of history. On paper, accounts under his management totaled an eye-watering $60 plus billion. In practice, there was nowhere near that much actual money. The illusion held as long as withdrawals and deposits stayed roughly balanced. Then came the 2008 financial crisis. Investors panicked and tried to pull out cash. Madoff couldn't meet the requests. The house of cards fell. He confessed. The scheme was revealed as the largest Ponzi scam run by a single person in history. The aftermath was devastating. Wealthy individuals lost fortunes, modest families lost retirement savings, charities and foundations collapsed because their endowments had been invested with Madoff. Trust between friends, communities, and institutions was shattered. His real product wasn't stocks or bonds. It was trust, leveraged to absolute destruction. Number 1. The Great Financial Crisis, when the whole system became the scam. All the previous scams had ringleaders, a Ponzi king, a fake crypto queen, a charming thief. But the biggest financial disaster of recent history, the one that wiped out trillions in wealth, didn't have a single mastermind. It had everybody. Banks, rating agencies, investors, regulators, homebuyers, politicians, and a story they all wanted to believe. In the early 2000s, the story went like this. Housing prices always go up, so lending money to almost anyone to buy a house is basically safe. And if we slice and dice those loans into complex financial products, we can make a fortune. Banks and mortgage companies in the United States began issuing subprime mortgages, home loans, to people with poor credit, low incomes, or no documentation. Normally, that would be seen as risky. But these lenders didn't plan to hold the loans. They would make the loan, bundle thousands of similar loans into a financial product, a mortgage-backed security, sell that product to investors around the world. Ratings agencies stamped many of these bundles with high grades, sometimes even AAA, the same rating as the safest government bonds. How? By using models that assumed only a small number of homeowners would default at the same time, and that housing prices would only ever go up or sideways. On top of that, Wall Street built even more complex products, CDOs, synthetic CDOs, that were essentially bets on loans most people didn't understand. From the outside, it looked like a win-win. Ordinary people could finally afford homes. Banks earned fees. Investors got higher returns from supposedly safe, diversified products. Inside the system, though, the foundations were rotting. Loans were being given to people with no proof of income, no stable jobs, teaser interest rates that would explode after a couple of years. When those adjustable rates reset higher, many borrowers couldn't keep up. Defaults started rising. As more people stopped paying their mortgages, the value of those mortgage-backed securities began to fall. The safest investments on bank balance sheets turned out to be ticking bombs. Investors realized they didn't know which securities were toxic and which weren't. Trust evaporated. Credit markets froze. Major financial institutions either collapsed, were rescued, or merged under emergency deals. Bear Stearns, Lehman Brothers, Egg, and others you've heard of in every documentary about 2008. Stock markets crashed. Retirement accounts shrank. Property values plummeted. Millions of people lost homes and jobs. Was every person involved a scammer in the traditional sense? No. But the effect was the same as a massive system-wide con. Risks were hidden, profits were privatized, losses were socialized, and the real bill landed on ordinary people who had never heard of a CDO in their lives. No single con artist ever stole as much money as the idea that housing prices could only go up. From clumsy emails about imaginary princes, to smooth-talking brokers in boiler rooms, from fake coins and fake profits, to a Wall Street mirage that nearly took down the global economy, the biggest financial scams all follow the same recipe. A story people want to believe. Easy money. Safe returns. Everyone else is getting rich. Numbers that look too perfect. Always up, never down. No volatility, no risk on paper. Complexity or trust used as a shield. It's very technical. You wouldn't understand. Don't worry, we're regulated. My friend's friend is in it. It must be legit. So how do you protect yourself in a world full of very professional thieves? If someone guarantees high returns with little or no risk, be suspicious. If an investment is so complex that no one can explain it to you in simple language, walk away. If the opportunity feels exclusive and you're being rushed to join, slow down. Real investments can wait. This isn't financial advice about what to buy. It is advice about what not to fall for. Because whether it's a guy in your inbox calling himself a prince, or a billionaire in a suit offering steady returns, the most dangerous words in finance are still. Trust me, you don't need to look too closely. So, which of these scams shocked you the most? And have you ever seen a modern investment opportunity that felt a little too familiar after hearing these stories? Let me know. And remember, in a world where scams can steal billions with a smile, sometimes the most profitable word you can say is no.